So as usual, we'll start with the first one, policy and asset prices. So this one was basically updating some work I did quite a while ago, and it kind of became less relevant more recently, but then increased in relevance more recently, which we'll go through in a second. But I guess setting the background context, first of all, is just recognizing again this wave of liquidity, the substantial policy easing, the unique circumstances of the current environment where cash deposits, bank deposits growth has really surged. And as a result, we're seeing what I've termed this procession of mini manias. So big tech initially, then it was companies like Hertz that got demolished and then bidded up by the Robinhood traders, trading cards, Bitcoin, GameStop, and now we've got this NFT phenomenon going on, and of course SPACs as well. My assertion are that those are mini manias, and that they're sort of whirlpools and eddies around the main current. And the main current is, well, first of all, that liquidity, but also looking at the more traditional assets. So if we look at this here, it requires a little bit of explaining. The chart on the left there is looking at the proportion of countries, and so this is just developed markets, but the proportion of countries whose current valuation is higher than long-term average. So we've got it in the red line for property. That's the combination of the price to income ratio and the price to rent ratio. And then for equities, it's the combined PE ratio there. And we can see that equities really had a brief reset before coming predominantly expensive or predominantly higher than long-term average, at least is the correct way of saying that. Property, of course, so with the latest round of rate cuts and drop in bond yields, mortgage rates, property valuations have actually are more widespreadly expensive than ever before. So I think it's worth just reflecting on this chart for a second. So if we look back at during the height of the dot-com bubble, a little bit before the burst, there was that situation where everyone was expensive. Then there was that little bit of a shakeout there with the EM debt crisis, Asian financial crisis there, and then ultimately, a big washout down to expensive, where that was, to where most countries were not expensive, which was basically the start of the new bull market, end of that previous couple of year bear market. And then in the lead up to 2008, of course, we had an interesting situation where, that was what precipitated the financial crisis was, of course, the bubble in property and the build-up in credit around that. And then, but it wasn't just property. Equities weren't cheap at that time either. And now we've got property at a whole new level, and equities increasingly expensive. And we look at the combined picture here on the right-hand chart there. So the proportion whose combined stock and property valuation, so basically combined version of the chart on the left, are just above long-term average. It's on par with what we saw just prior to the financial crisis. Could still go a little bit further compared to the dot-com bubble. But if we look at those that are at least 20% higher than long-term average, so those ones, we could definitely say those are expensive. It's getting up there, not quite again at the same level, but definitely on a different scale to pre-08. So it's it's interesting. Pictures like this are on first glance, I would say, sort of bearish picture given the implications that has for the longer term outlook. But it's not necessarily a barrier in the short term, as long as that tidal wave of liquidity continues to wash over things. But of course, if we sit here and agree that the policy stimulus, the wave of liquidity, is either the or one of the key drivers, then we also have to say that when that tide goes out, then that's when this will really come home to roost. So, and then I've just shown here. So in terms of that previous chart, the combined picture. This is what their combined readings were, and it gives you sort of an insight into the lay of the land there. Take note of who's down the right hand side of the table, because that'll become interesting for the next topic. And just honing in on property for a second. So again, we can start to see there, this is quarterly data, we can start to see there that property price growth is beginning to accelerate, which it's fairly simple maths. When interest rates go down, property prices go up, because if everything else is equal, and it really is, but if everything else is equal, you cut interest rates and it improves the buying power of the average citizen. So it is almost always going to boost property prices as such. You can see that the valuation metrics definitely becoming lofty, and virtually zero reset during the pandemic. And then again, just looking at the the lay of the land there, so the median and upper lower quartile. So we'll look at the upper quartile, the more expensive ones are more expensive than ever, and median is basically a record high. So it's, I think, something that I'm going to be probably tracking increasingly as we get towards even further loftiness of valuations, where these mini manias give way to sort of the main current, or the big asset classes becoming excessively overvalued, which of course, again, in terms of when it's time to become structurally defensive, that's going to be when policy turns the corner, which I would say is the biggest risk to markets over the coming years.